Most retirees think the hardest part of retirement is saving the money. They are wrong. The hardest part is holding on to your money once the tax man comes for his cut. And so today we are talking about the retirement tax time bomb no one warned you about. And before you assume this does not apply to you, let me warn you. If you have done a good job saving and building up a nest egg, if you have money in traditional retirement accounts, and if you plan to live off your income instead of your principal, you are exactly who this hits the hardest. Let me show you why. A few years ago, I sat across the table from a retired couple. They'd worked their whole lives, saved responsibly, done everything their advisor told them to do. They were proud of their retirement balance, and they should have been. But when we walked through their income plan together, they realized something they never expected. Their tax bill was higher in retirement than it had ever been while they were working. That moment is when the light bulb goes on for most retirees. They realize the big problem was never chasing gains or avoiding market losses. It was the tax bomb hiding under the surface. And once you see it, you cannot unsee it, because here's the tax mistake almost everyone makes. Most people are taught one simple rule: contribute to traditional retirement accounts, defer taxes now, pay them later. Sounds smart until you actually reach the future. Because then in retirement, taxes do not go down the way people expect. In many cases, they go up. Let me explain why. During your working years, you had control. You controlled how much you earned. You controlled when you contributed. You controlled how aggressively you saved. But in retirement, control suddenly shifts away from you. Required minimum distributions eventually force income onto your tax return, whether you need it or not. Social Security adds another layer of taxable income. Investment income stacks on top of that. And suddenly your tax bracket is higher than you planned for. That is the tax time bomb. It is not one single event, it is a slow buildup that explodes over time. And here is the twist most people never hear: it's not just about your income tax bracket. There are knock on effects on your Social Security taxation. They drastically raise your Medicare premiums, and they affect how long your money actually lasts. This is where the dominoes start falling. Most retirees believe Social Security is tax free. It is not. Depending on how your income is structured, up to the majority of your benefit can be taxable, not because you did something wrong, but because your other income pushed you over invisible thresholds. And Medicare works the same way. Higher income does not just mean higher taxes, it can mean higher healthcare premiums too. So now you are losing more of your Social Security, paying more for healthcare than others, and drawing down your portfolio faster than expected, all thanks to decisions you made years ago with good intentions. That's why the most dangerous retirement belief is, I will just pay the taxes later. Later is the most expensive time to pay them, because later you have fewer options. That's why the top 1% of retirees do something very different. They do not focus on how much they make, they focus on where that income comes from. They understand that not all dollars are taxed the same. And this is where proactive tax planning changes everything. Tax planning is not tax preparation like what your CPA might do. Tax preparation only looks backward, but tax planning looks forward. It asks a different question: not how much tax did I pay last year, but how much tax will I pay over the rest of my life? That shift alone can save you hundreds of thousands of dollars. It's why two retirees can have the same income, same lifestyle, same spending, but one pays far more in lifetime taxes than the other. Why? Because one planned where their income came from. The other just took withdrawals and hoped for the best. And this is exactly what we help our clients do at Bunza Wealth Management. We do not just manage investments, we also manage the tax impact of retirement decisions, because your returns do not matter if taxes eat them alive. Here is another truth most retirees avoid: waiting too long to plan increases your risk. How come? Because every year you delay proactive tax planning, you lock in future tax exposure. And once required minimum distributions begin, your flexibility shrinks fast. But before you panic, let me say this: there is good news. This problem is fixable, but only if you address it early. The goal is not to avoid taxes entirely. That is unrealistic. The goal is to control when and how you pay them. Lower brackets, lower lifetime burden. More money staying in your pocket instead of going to the government. And if you are watching this thinking, I wish someone had explained this sooner, how can I lower my retirement taxes? Then there is a free educational video linked below that walks you through how we help retirees create tax efficient income plans. And if you want help implementing this, you can schedule a call with our team to see if we are a good fit. Thanks for watching today, and I'll see you in the next video.